interest rates are we're hanging in there in that mid six range on interest rates.
Hey there, everyone. Dave Barlow with Sell for 1%. We've got the gang here this morning. It is Thursday, January 11th. It's amazing. 11 days already into this year. I mean, really, that it's weird because it's like 11 days already. Time flies when you're having fun. We got all kinds of action going on in the market. And we have our good friend Rich Sircone with Equitable Finance here to tell us a little more about what's happening with interest rates. Rich, what you got for us?
Hey Dave, how are you? Well, interest rates are we're hanging in there in that mid six range on interest rates. We've had a couple of big data points which were not really in favor of lower rates. The employment number last Friday, was a little bit stronger than expected, which is bad for interest rates.
That'll get
This morning, about an hour and a half ago, we got the CPI numbers which is the Consumer Price Index inflation numbers, stronger than expected. The CPI year over year, 3.4 versus a 3.2 expectation. The month over month CPI was 0.3 versus a 0.2 expectation, and the core year over year 3.9 versus 3.8 doesn't sound like much to maybe the average person, but those are numbers the market's watching. And immediately after that, some of the analysts were saying, well, we might not see as many rate cuts as we think we were going to see this year by the Fed. We know it with and the Fed has said all along, they are data dependent. They're looking at what the data says, and that will drive their decisions on lowering or raising interest rates. So not a great number for us, but those things change in the blink of an eye in this crazy world we live in. So let's hope for the best.
Yeah, I was going to fill up my tank. I think it was Sunday. Gas in my area was $2.39 a gallon. And then Tuesday, it's $2.89. It jumped 50 cents in basically a day. So I'm guessing, we got the word about, the employment numbers, and now we have the CPI. So gas will go above $3 because of these numbers. Everything's dependent on, it seemed, these numbers coming out. I mean, it would seem like to me, they've been fighting it. What is the real cause of better employment numbers? I mean, why would that cause interest rates to go up?
Well, because the Fed they have a dual mandate, is what would be said there, to first of all fight inflation, but at the same time to bolster employment. So they're trying to make sure that we don't have a crash where people all lose their jobs. But at the same time, they're going to fight inflation with higher rates if necessary to tamp down the economy. So you have this counterbalance all the time. So when you see stronger employment numbers, it gives the Fed more liberty to raise rates because they have room to move there based on stronger employment numbers. That's the Fed's dual mandate.
It seems like on that description, it's almost a balance of more money going into the economy, into people's hands. They're probably going to spend it, so let's kind of curve that as much as we can.
Exactly. Yeah, and no one thought they could do it, but it appears that the Fed is going to pull this off, where they have raised rates, but they haven't crashed the economy. The economy is still moving along at a nice pace. People still have jobs. So the fear was when he started to raise rates that everything would crash. So it appears they're taking us in for a soft landing, if you will.
Well, they certainly slowed up the home buying situation with the higher rates. We are happy to see rates coming back towards 6.5, and as Rich always says, depending on your particular credit situation, there's going to be a little bit of a range there. I think last week we talked about rates by the time we get into April, May. With any luck, we'll be down into the fives. I thought maybe 5 to 5.5. That, I guess, will be dependent on what the Fed does as they look at these numbers as we move along. But being a presidential year, I think they're going to want to see interest rates come down, gas prices come down, and as a result of that, the CPI, Consumer Price Index, hopefully will come down as well as people have to spend less of the money in their pocket to be able to afford to live.
Yeah, speaking of the housing market and how it has slowed the housing market, some of the numbers do show that things like household appliances are down, and the stores like Home Depot and Lowe's are not as strong as they were back when the housing market was roaring. So housing market drives a lot of other things, and that could, you're correct, Dave, that could definitely lead to impetus to go ahead and lower the rates anyway.
Well, we certainly saw it after 9/11. The housing market went flat for 3 or 4 months. The airline industry basically died on the vine. It recuperated until we got to 2008, and then we headed into the foreclosure crisis. And so, again, you can kind of see these cycles as we go along. And, yeah, the housing industry feeds a lot of other industries. You know, as you mentioned, the mortgage companies, Home Depot and Lowe's, Menards, which is here in Columbus now. They became huge companies because people weren't moving, they were remodeling. And so they were buying a crap load of stuff from these companies, Home Depot, Lowe's, whoever. And I thought we would maybe see some of that now where interest rates went high and people say, well, instead of moving, let's remodel the kitchen. Instead of moving, let's finish the basement. Instead of moving, let's, do this or whatever. And so obviously time will tell. We'll see how it all goes, but it seems like things are percolating. We're seeing it here. Jay, maybe you can address real quick what you're seeing on the buyer-seller side with listings and things like that.
I mean, if you're priced right and you were in the market and you were at 8%, now it's 6.5%. I mean, things are moving. So, I mean, we've seen it's been a strong December, and the January's been good so far. I mean, to me, it feels more like it felt in 2020 and 21 in that December time, leading to a nice strong spring. It feels better than it felt last year, and so we'll see what happens. I mean, everything you guys are talking about, I'm off the reservation on, and so it's like we'll see where things go and where rates go. If rates stay low, then I would expect for spring to be off the hook. If rates, go back up, then it's going to, cool things back down. So we'll see what happens.
I was looking at the numbers year over year, the Freddie Mac number, and the new numbers will come out today. But as of last Thursday, the average interest rate a year ago was 6.61%. And then the average rate today is 6.62%.
And yeah, but the big difference is this time the rates are coming down.
Right.
Last year they were going up.
Yep.
So it's a whole different dynamic.
No, you're exactly right. And I think that impacts people's attitude. And so we're going to, I guess, kind of put it to the test here as we move into the spring market, where it's about the same interest rate. Do we see more homes sold here or go into contract here in January? And then that leads into February, March, and April. And as you said, Jay, the market moves upwards versus downwards due to perception of interest rates, albeit they're kind of the same. All right, guys. Well, thank you very much. Appreciate the input and the conversation. we're all looking forward to Rich hammering those interest rates down. And we'll work on the sellers to keep prices competitive. And Jaime, you bring all the buyers that you possibly can and buy up those houses.
I'm on it.
If you like this information, please be sure to like and subscribe. Click on the notification bell. We try to do this at least once a week, give you an update of what's happening in the world of finance and mortgages and real estate. And if you have any needs whatsoever, give Rich a call for your mortgage needs, or give one of us a call here at Sell for 1%. We'll help you buy and sell. All right, guys, thanks. Great conversation. We'll see you next week.
Thank you, guys.